You don't have to have a terminal illness to access money tax-free from a life insurance policy. In this educational episode, I'm going to address the question, can I access money tax-free out of an IUL insurance policy without being critically ill? Yes, you can, and I'm going to show you how easy it is to do that. But I'll also talk about what an accelerated death benefit rider is, which you can also get on a permanent life insurance policy. So stay tuned. So my name's Doug Andrew. I've been helping people optimize financial assets and minimize taxes now for nearly 5 decades. And I've helped thousands of people optimize assets by using max-funded insurance contracts where they are using it primarily for living benefits to accumulate their money tax-free under Section 72E of the Internal Revenue Code that allows you to earn interest and dividends and grow your cash value inside of a life insurance policy, totally income tax-free. But Section 7702 of the Internal Revenue Code dictates how you can access that money while you're alive without triggering income tax. And then at the end of the day, when you finally pass away, anything left in the policy blossoms. It transfers out income tax-free under Section 101A in the Internal Revenue Code. Nothing else in the Internal Revenue Code does what I just said, the way that I just described it. I've taught advanced continuing education to many CPAs and tax attorneys for decades, and I've always challenged them to show me any other financial instrument that does that, and they've yet to show me anything. So when people ask me, golly, can I access money out of my life insurance policy, specifically an IUL policy, without having to die? Can I do it without triggering tax? Can I get it tax-free without being critically ill? Because a lot of times people hear about critically ill or terminally ill people that they have a special provision, maybe with their insurer, the insurance company, that allows you to access part of the death benefit without actually dying to get part of the death benefit, okay? So I'm going to separate those two concepts here, make sure you understand them, and I'm going to explain why. I've always used max-funded IUL to be able to access money anytime I need it for whatever reason. It doesn't have to be because you're having financial difficulties because of a critical illness and you're maybe in a facility and you're running up healthcare costs and what have you, and you don't have long-term care insurance or whatever. So I've always believed in self-insuring. But let's go back to this concept of being able to access part of the death benefit. So let's say that you're 60 years old and you take out an IUL policy and your goal is to take the least amount of insurance the IRS will let you get away with in order to have your money grow tax-free and be able to turn on tax-free income, which is what over 90% of my clients wanted to do. They wanted to use the life insurance policy primarily for living benefits. So a 60-year-old non-smoker that qualifies, passes the exam, may be required under the IRS guidelines, these are TEFRA-DEFRA guidelines, and those are tax citations, to have about double what they put in insurance death benefit. So if you wanted to sock away $500,000, maybe not all in one lump sum, but $100,000 a year for 5 years or whatever, and you wanted to be able to have that grow at the best net internal rate of return at the end of the day, so that if you averaged 11, you might net 10, like I have for the last 25 or 30 years. Then you would take the least amount of insurance the IRS will let you get away with. So if you're age 60, that would be about $1 million of life insurance in order to accommodate $500,000 of premiums, okay? Now, some people say, wow, Who pays $500,000 for $1 million of life insurance? Well, our clients do, because they're not after the life insurance so much. They're after the $500,000 growing at an internal rate of return within 1% of the gross rate of return. If you earned 8, you'll net 7. If you earn 11, you'll net 10. And so you take the least amount of insurance the IRS will let you get away with, okay? Now, you could buy way more life insurance for $500,000 than $1 million, but that's not the objective. So assuming you're doing it for living benefits and you're healthy, and that's your primary objective, you set up a life insurance contract, an IUL policy, with $1 million death benefit. You're 60 years old, and you begin to put in $100,000 a year for 5 years, $500,000. You can't put in more than that in the first 11 years. The insurance company would have to refund anything over $500,000, because that's the most you can put in if that's what you structured it with $1 million policy, okay? Now, if this is a little bit fuzzy to you, I have a lot of other educational videos that talk about TEFRA, DEFRA, and TAMRA on this channel. So let's say you do that, and while you're funding it, because this has happened many times with my clients, while they're maximum funding their policy, all of a sudden, they start getting diagnosed with dementia, and then it turns into Alzheimer's, or maybe they have a grand mal seizure, and all of a sudden they're epileptic, or they're diabetic, and all of a sudden they have some setbacks, and the doctor says, your life expectancy is only 7 years, or 8 years, or 4 years, or whatever, or heaven forbid, they have a heart attack, and it's really serious, or they get cancer, and it's in the 4th stage, and I've had clients who have been diagnosed in the 4th stage of cancer, Hodgkin's disease, or whatever it is, and the doctor goes, your life expectancy now is 9 months to 2 years. Well, all of a sudden, you're not going to finish funding that policy necessarily, because you may need that money to take care of some of the medical expenses. But maybe you've put in $100,000, $200,000, maybe you put in the whole $500,000, and the death benefit is $1 million. Now, a lot of times people have life insurance and they don't have a lot of cash value in it, but they have the $1 million death benefit, let's say, okay? And they know they're going to die sooner than later. So some insurance companies will allow you to be able to access part of that $1 million death benefit in this example. And many companies will have what is called an accelerated death benefit. It usually comes as a rider. You usually have to take it out when you first take out the policy. It usually doesn't cost anything, or not much of anything. And that just means that if you need to, and if you are critically or terminally ill, and you can prove that, the insurance company will give you a portion of that $1 million death benefit without you having to die first for your beneficiaries to get it. So you don't run up a whole bunch of medical bills and leave those bills behind to your family, and then they're required to assign the life insurance proceeds to pay off those debts. You know, people have done that. But you can actually access maybe a few $100,000 of that $1 million death benefit before you die, okay? So that's called an accelerated death benefit rider, and you can access part of the death benefit before you die. Now, I mentioned earlier, most of the time, my clients maximum fund their policies, and they were healthy enough to qualify, so many of them do not actually end up being diagnosed with a terminal illness within the first 5 years, even though it's happened. So let's say you have $500,000 in that policy, and that $500,000 is growing. My average rate of return since 1980 on Universal Life and then Indexed Universal Life has been 9.62%. If you round that down to 9.6, your money doubles every 7.5 years. So once you had 500,000 in there, that would double to $1 million within 7.5 years. Now your cash value equals the death benefit. The actual cost of insurance is really next to nothing, but TEFRA and DEFRA tax citations say that the death benefit has to be 5 percentage points ahead. So if you happen to die when you have $1 million of cash value inside of $1 million policy, the insurance company would pay out $1,050,000, but they're only going to charge you for that $50,000. That's why the cost of the insurance gets cheaper as you get older, and a lot of agents don't understand that. If you went another 7.5 years, that million doubles to $2 million. And if you died, the insurance company would pay $2.1 million tax-free. But $2 million of it was your own money. So if you're max funding the policy, you just access the cash value because it is the death benefit. But see, you're not having to have an accelerated death benefit rider. It's your money. You can go grab not only the interest on that million, which might be 10% a year, that's $100,000. You can access 900,000, even 940,000 of your cash value without causing the policy to lapse. So you just simply access the money. You can withdraw it, you can borrow it. People say, why would you borrow it? Because if you borrow it out, you could borrow at 2% and they'll credit you 2%. It doesn't cost you anything to borrow it, so that if you wanted to, you could pay it back. But many of these IUL policies will have a no lapse guarantee rider. And so you have to leave maybe 6 or 7% of that million in there to make sure the policy doesn't lapse, because that would trigger unnecessary tax. If you pulled out the whole million, you don't want to have to pay tax on that 500,000 that it grew by. Does that make sense? And so you don't want to do something stupid. But as that money grows, you simply use that as collateral. Many people may borrow at 4 or 5% and keep earning 10%. That's called arbitrage. They're making 100% more than the insurance company is charging you, so it keeps growing. These are all explained in my various books and other educational videos. But if you really need to access money out of a max-funded indexed universal life insurance policy, chances are you'll have enough cash value in there that you just fill out one page. Are you going to withdraw the money? Are you going to borrow it? And it's not a one-time. You can do it anytime, as many times or anytime you want. And you access the cash value totally tax-free. You're not accessing the death benefit. You could, but if your cash is the death benefit, if you've self-insured by max funding it, you don't need an accelerated death benefit rider. Does that make sense? Because it's your money. Also, if you do have life insurance and you don't have an accelerated death benefit rider, and you are critically ill, but you may live 2 or 3 or 4 years, you could actually sell that life insurance policy for cash on what is called the life settlement market. There are institutions and companies and private investors that actually will buy your life insurance policy. Now, people say, why would they do that? Do the math. I had a gentleman that he actually passed away on the operating table. He had a heart attack and so forth. And so his life expectancy, after they revived him for the next year, they said, oh, you're probably not going to make it more than 2 years. He thought otherwise. And he had a $3 million life insurance policy. And he was having to pay about $8,000 a month into it because he was minimum funding it because he had had his first heart attack 7 years earlier. So he decided not to max fund it. So he had $3 million of life insurance, and he thought, you know what? I think I'm going to beat the odds. We sold that $3 million policy for $1 million. So he got $1 million tax-free cash for selling his policy. And if he lives a long time, that would have been a good deal. If he dies sooner than later, the people who paid him $1 million, where else would they be able to invest $1 million and in 2, 3, 4, 5, or 6 years have it grow to be $3 million tax-free? So it was a win-win. He got $1 million to travel and do things that he wanted to do in the last few years of his life. And the person who bought his $3 million policy for $1 million, it was a win for them because they're going to get $3 million sooner or later. And he would have to live a long time for it to be not a great investment return. So there's all kinds of ways or exit strategies out of a life insurance policy. You don't necessarily have to be critically ill or even prove that you're terminal, but you can access the cash values if you maximum fund it. You can sell your policy. But if you have a death benefit and the insurance company has an accelerated death benefit option, you can even use that to access some of the death benefit. You do not have to be critically ill, though, if you have the cash in the policy anyway. Does that make sense? If you want to learn more about what a laser fund is and max funded indexed universal life, it's my favorite financial vehicle. And I've been helping people optimize assets and minimize taxes now for 48 and a half years. I want to gift you a copy of my most recent best-selling book called The Laser Fund, How to Diversify and Create the Foundation for a Tax-Free Retirement. But you can use this for all kinds of goals, for life, for death, whatever, emergency funds, college funding, retirement, real estate management. I call it the dream solution. So this is a 300-page book with all the charts and graphs and explanations on the left brain side. On the right brain side are 62 actual client stories of how people have used the Laser Fund for all kinds of financial goals. So here's how you claim your free copy. Simply go to laserfund.com, L-A-S-E-R fund.com. You contribute a nominal amount toward the shipping and handling. Have a little bit of skin in the game. I'll cover the rest of that cost, and I'll pay for the book. I'll fire out a copy to you. Don't miss out. I'm sending out about 1,000 of these a month. And while you're in there, if you would like to listen and learn or watch and learn, there's options there for audio and video. And check out some of the educational webinars we hold on a regular basis. You can even fill in for an appointment to talk to an IUL specialist to see how this may benefit you in your particular set of circumstances. You want to make sure you structure it correctly and fund it properly so that it qualifies to be what I call a laser fund. Laser means liquid assets safely earning returns.